Thanks for clicking! All eyes were on Stats Canada this morning as it was set to release Canada's inflation data for the month of April, with most economists thinking inflation would come in at 2.7%, down from the previous month's 2.9%. We got our answer at 8:30 this morning when inflation came in, as expected, at 2.7%.
This is largely as I predicted.
However, the real news was the continued slowdown in measures of core inflation, both of which came in under 3%. And the as-expected inflation data coming from StatsCan comes on the heels of the blowout jobs numbers that were released a few weeks ago, which initially caused the markets to pare back their rate cut expectations. Yet, the jobs numbers didn't stop RBC from not only predicting a June rate cut coming from the Bank of Canada, but also 200 basis points worth of rate cuts over the next year or so, representing a major policy shift from that of the Federal Reserve, which RBC says is only going to be cutting rates by 75 basis points. Yet, as we'll see today, the basis for these predictions coming from RBC are questionable, if even present.
Since when does that matter?
So what I want to do today is go over Canada's inflation data for the month of April, take a look at these predictions coming out of RBC, compare them with the data that we have available, and then discuss what to look for next. Speaking of next, the next interest rate announcement coming out of the Bank of Canada is set for 2 weeks from now on June 5th, with a press conference to follow thereafter, and we'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this inflation data. Onto the data. As mentioned, Canada's headline inflation data came in as expected at 2.7%. Major upward contributors to the inflation rate were mortgage interest costs, rent, food, gas, and auto insurance, with the biggest downward contributors coming from telephone, internet, men's clothing, homeowners' replacement costs, meaning home prices, and digital computing devices. So, the prices for Canadian shelter, food, gas, and car are all going up, but internet is cheaper than it was a year ago.
Mission accomplished.
Yeah, considering that even Stats Canada notes that food prices are up 21.4% from 3 years ago, this isn't exactly something to celebrate. But it wasn't just headline inflation that was down. As mentioned, the real news is the downward movement of measures of core inflation, those measures which the Bank of Canada looks to when deciding whether or not to cut interest rates, which were both down in April. Core median dropped from 2.9 to 2.6, and core trim dropped from 3.2 to 2.9. And month-over-month measures of core inflation are also flattening as well, especially compared with this point in time last year. So, good news coming out of headline inflation, and really good news coming out of measures of core inflation. With that said, April's inflation read isn't exactly a game changer. Prior to the release of the inflation data, markets were expecting a 41% chance of a cut in June, which changed to 45% following the StatsCan release. With that said, the data will no doubt put more pressure on the Bank of Canada to cut rates at its June announcement, which RBC, followed by an army of the usual suspects on TikTok, is predicting to be the case. But it's not just the potential for a June rate cut that is making the headlines, with RBC saying that it expects 200 basis points worth of rate cuts coming from the Bank of Canada by the third quarter of 2025, while only expecting 75 basis points worth of cuts coming out of the Federal Reserve. If that is in fact the case, if that does materialize, that would put Canada's policy rate right around 3% by the third quarter of next year, whereas the Fed's would be sitting around 4.5%. The largest rate differential that Canada has seen since the mid-1990s. Given the downward pressure that such a rate differential would put on the value of our currency, as we've talked about so many times before on this channel, that obviously raises the question, why would the Bank of Canada risk such a divergence?
For me. Just for me.
The reason for the divergence from the Fed in 1996 was the 9% unemployment rate. Canada had to cut rates to stimulate the economy. But right now, unemployment is still sitting at 6.1%. Is RBC making the argument that the economy is going to deteriorate to such an extent that unemployment will rise by 50% in a little over a year's time? And for that reason, the central bank is going to risk that massive policy divergence and the ensuing inflation? RBC doesn't say. In fact, the article being pushed by the usual suspects arguing for 200 basis points worth of rate cuts and the house price gains which are expected to follow only mentions the word employment twice. One being a headline mentioning the 90,000 jobs added in March, and the other was RBC noting that unemployment was holding steady. And those are the only two mentions of the unemployment rate in this entire article. You can't just predict 200 basis points worth of rate cuts without explaining why.
Sure you can.
And RBC isn't even forecasting a recession. It's not even forecasting a major downturn in the economy, which would necessitate those rate cuts. Merely noting that economic growth is going to be a bit weaker over the next few quarters, but not declining. The economy is not expected to be in a recession. Further, RBC does note that inflation is in fact coming down, and as we saw today, that is in fact the case. However, here is month-over-month measures of core inflation, core median, for the past 24 years. And this is the evidence available to the Bank of Canada showing that core inflation is moving back down to target. Is that enough data to predict 200 basis points worth of rate cuts coming from the Bank of Canada and 150 basis points worth of policy divergence between us and the Federal Reserve? Well, RBC doesn't say, only noting that imports from the US only account for about 35% of Canadian imports, so the inflationary pressures of a weaker dollar shouldn't be as strong as many are anticipating. So RBC is making the argument that Canada is going to see major rate drops over the next year, and we're going to see a big policy divergence between us and that of the United States, but isn't really explaining why. We don't yet have enough data to show that inflation is sustainably moving towards that 2% level, and in relative terms, the economy is still fairly strong, at least stronger than it was the last time Canada saw such a big policy divergence. Now, this isn't at all to say that the Canadian economy is booming. A large portion of those 90,000 jobs that were added in April came from population growth, but that's not really expected to stop anytime soon. But given that the Federal Reserve is expected to remain higher for longer, then why is the Bank of Canada going to risk the major policy divergence between us and that of the Fed, as well as the reignition of inflation, when the economic data that we have, for now at least, doesn't show that the economy needs it? The central banks don't just cut rates to make the real estate industry happy. They do it to stimulate the economy. And, at least right now, and unacknowledged by that of RBC, it doesn't look, right now at least, as though the Canadian economy is in need of them. Now, this isn't to say that we won't get those 200 basis points worth of rate cuts. What it is to say is we don't get those 200 basis points worth of rate cuts amid a relatively strong economy. As we saw in the 1990s, we didn't get the cuts then. We didn't get that major policy divergence from that of the Federal Reserve then without a weakening economy. And chances are, the Bank of Canada is not going to risk reigniting inflation without a weak economy this time. With that said, we are going to get our answer on those rate cuts in 2 weeks' time coming from the Bank of Canada on June 5th, and we'll obviously have an update out on those rate cut announcements on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.